Welcome to the lecture on Bank Reconciliation Statement. After this lecture, you will be able to learn the following objectives. Define the meaning of Bank Reconciliation Statement. Explain the need of a Bank Reconciliation Statement. Explain the bank passbook or bank statement. Explore the causes of difference between a cash book and a passbook. Learn the procedure for preparing a bank reconciliation statement. Introduction. Now let us start with the concept of bank reconciliation statement. An organization maintains records of their bank and cash transactions in the cash book. The cash book shows the balance of the bank account as well as the cash account at the end of the accounting period. All the deposits and withdrawals are recorded in the bank column of the cash book of an organization. A bank statement is received periodically from the banker, and the transactions recorded in the cash book are verified by matching them with the bank statement. Meaning of bank reconciliation statement. Let us see a video for better understanding of this topic.
Bank reconciliations. Those are the statements that you get either in the mail or you can get online. And a bank reconciliation, if you flip it over to the back, looks like this. You have the balance per your bank statement. There's a place for you to add in things that the bank doesn't know about, and a place to subtract things that the bank doesn't know about to come up with the adjusted or total balance. And that total balance is supposed to agree with your checkbook, isn't it? But it never does. And you know why? Because they don't tell you about the other side, which begins with the balance per your checkbook. There you add in the things the bank knows about, but your checkbook doesn't. You subtract those things that, again, the bank knows about, but your checkbook doesn't, to come up with this adjusted balance. And these two balances then will agree, and your checkbook then will agree with your bank account. So that's what we're going to be looking at. Now we need an example to kind of put in the numbers. So we're going to be dealing with problem 5 in the text. And it says in the part A that the balance per your bank statement, so this is in little a, that's supposed to be an A, is $52,351.46. So that's given. And that again is from your bank statement. Your balance per your books in A, your checkbook says right now you have a balance of $42,754.16. Now these don't agree, do they? No. In part B, it says that you have a deposit in transit. In other words, you made a deposit, but it got into the bank after hours. So in other words, you know about that deposit, but the bank doesn't. So we need to add that. So the B, we're going to add our deposit in transit, and that's $5,220.94. So we're going to add it to the bank statement. In part C, it says we have outstanding checks. In other words, checks we've written and our checkbook knows about, but they're outstanding, meaning they haven't cleared the bank yet. So I think we need to subtract those. So in part C, our outstanding checks are $3,936.80. So I'm going to put that in brackets to remind myself to subtract it. Then in part D, it says we have an error. A check that we wrote, which cleared the bank at $1,920, we wrote in our checkbook as only being $1,380. So, well, first off, I made the mistake, so I have an error. And second, I'm going to have to subtract that error because remember, it cleared the bank at $19.20, but the check in the checkbook was $13.80. So as you can see, I under-recorded it in my checkbook, so do I need to take a bit more off? So the amount that I'm going to take off is the difference between the $19.20 and the $13.80. And that amount is a nice number, which I think I have to do in my head right now. So let's see, that would be 4, and that'd be 8, $540 mistake. So I'm going to subtract that. That's Part D. Part E says we have a service charge. In other words, the bank is charging us for the privilege of banking. So E, we're going to subtract our service charge of $25. Now in F, it says the bank collected a note on our behalf. In other words, it was our money, but the customer sent the money directly to the bank put it in our account, and is now informing us that they have collected a note receivable on our account for $12,000, plus that note had interest of $240. Now when we talk about interest in a note here, if this is note receivable, this would be interest income, wouldn't it? Because we've earned it. Then that was F. In G, it says that a customer done us wrong. So we have what we call an NSF, a non-sufficient funds, a bounce check where a customer didn't pay us, so they took the money out of our account again, and now we have to go back against that customer and find them. And the NSF was for $183.56. So I got to subtract that back out. So that was G. In H, we have an error. And the error was that the bank took money out of our account by mistake. So whose error was it? The bank's. So does the bank need to give us back the money they mistakenly took out of our account? Well, I hope so. So we'll add back $850 for that mistake. In I, it says that we earned interest on our account of $240. So I'm going to add that interest income in because I earned it, because I kept my money in the bank. And those are all the items. Now let's see if when we total it up, if it equals. And I think it will. So if I take the balance per the bank, add the deposit in transit, the error, subtract the outstanding checks, I get $54,485.60. On the balance per books, if I take our balance, plus we add back the note, the interest income, the interest earned, the error, the service charge, and the NSF, we subtract those out. We again get $54,485.60. So as you can see, our bank reconciliation balances.
Bank reconciliation. When money is deposited into a bank by a customer, the bank updates the account of the customer by recording the entry in the debit side of the cash book. Similarly, when money is withdrawn from the bank, it is recorded in the credit side of the cash book. The bank also maintains an account of the customer in its books of account. In the books of account, deposits made by the customer are recorded on the credit side of the customer's account and withdrawals on the debit side. A copy of it is also given to the customer for his or her knowledge in the form of a bank statement or a statement of account. A bank reconciliation statement can be defined as a statement prepared at periodical intervals indicating the items that cause disagreement between the balances as per the bank columns of the cash book and the bank statement on any given date. This statement is important because of the following reasons: brings out any error that may have been committed in either the cash book or the bank statement, avoids any delay in the clearance of checks which can be highlighted by the reconciliation, helps management to check the accuracy of entries recorded in the cash book and keeps track of checks which may have been sent to the bank for collection. Need for bank reconciliation statement. When an organization opens a current account in a bank, the bank provides the account holder with a bank statement, a checkbook, and a pay-in slip book. Whenever the organization withdraws money from the bank, it uses the check, whereas whenever it deposits money or check into the bank, that is, uses the pay-in slip. The bank statement mentions the amount withdrawn, deposited, and the balance amount. This is kept safely by the organization. The bank reconciliation statement is prepared periodically to ascertain that all the transactions related to the bank are recorded properly in the bank column of the cash book and in the passbook. Bank passbook or bank statement. This statement provided by the bank is called a bank statement. The bank statement is provided regularly at short intervals after completing all the transactions up to the date of dispatch, so that the concerned person can view his or her own account transaction as it appears in the ledger of the bank and report for correction if any discrepancies are there. Cause of difference between cash book and passbook balances. The causes of difference are ascertained when items in the bank statement and in the cash book are compared. The list of causes of difference in the balances by the cash book and the bank statement on any particular date. Following are the causes of difference in the balances as shown by the cash book and the bank statement on any particular date. Checks deposited into the bank but not yet collected and credited. When checks are deposited into the bank, the account holders immediately debit his or her bank account with the related amount in his or her books of account. However, in the books of bank, the concern's account is not credited until they are actually collected by the bank. It is quite usual that some of the checks deposited by the concern may remain uncollected at the time the bank statement is sent for comparison. Checks issued but not yet present for payment. Similarly, the entry for the issue of check is made in the books of the concern immediately and the bank account is credited. However, in the books of bank, entry for payment can be made only when check is presented for payment. At the time of comparison, it is quite possible to find out some cases where checks were issued and recorded in the cash book but not presented for payment and remained unrecorded in the bank books, and therefore causing a difference. Bank charges. Banks render various services to its clients, and for that it levies charges. Entry for such charges is made by the bank, but the corresponding entry for the charges does not appear in the cash book of the concern because it is not known to the client until he or she receives a statement, which causes a difference. Amount collected or credited by bank on standing instructions. Often, a concern issues standing instructions to the bank to collect dividend and interest on investments on its behalf. When the bank collects such amount, it immediately credits the concern's account with it. The necessary intimation and advice is sent to the concerned party after this is done. Amount paid or debited by the bank on standing instructions. The concern may also issue standing instructions to the bank for making some payments on its behalf and debit the concern's account with it. For example, life insurance premium, rent, and payment of installments. Interest credited by bank. Banks normally do not allow any interest on current accounts. However, if it is allowed, the concern's account is credited by bank, which would enhance the organization's balance with bank. On the other hand, the organization would record it on the debit side of the bank account in the cash book only when the bank statement is received. Interest debited by bank on overdraft. If the organization withdraws more money from the bank than the available deposits with it, then it is called an overdraft. Overdraft facility is permitted to the party by the bank only when it fulfills certain conditions. The bank charges interest on overdrawn balances. Direct payment by customers into the bank account. Sometimes customers may deposit money directly into the organization's account in the bank. The bank would immediately record the entry on the credit side of the organization's account and therefore in the bank statement and enhance the balance. However, the organization would debit the bank account in the cash book only when it gets the intimation or the bank statement. Dishonor of check or bills. When checks are deposited in the bank for collection, the organization debits the bank account in the cash book. It increases the balance immediately. However, the bank would credit the proceeds of checks only when they are to be collected. The organization would credit the bank account only on receiving the intimation or the bank statement from the bank. Errors. Difference in two balances may also be due to some errors in the recording of transactions by either the organization or the bank. For example, the check deposited in the bank for collection may not be recorded at all, or check may be forgotten to be sent to the bank though necessary entry has been recorded in the cash book. Procedure of preparing a bank reconciliation statement. Generally, at the end of every month, the entries in the cash book are compared with the entries in the passbook. For determining the exact cause of difference between the two, these books are examined and then a reconciliation statement is prepared. In this statement, all the causes of differences are down. Suitable correcting entries are passed in the books if necessary. For preparing a bank reconciliation statement on a given date, the following procedure is adopted. Take balances either as per the cash book or the passbook as a starting point. Compare the items appearing in the bank column of the cash book with the items appearing in the bank column of passbook. Items in the passbook are marked with the entries in the cash book. After that, a list is made of items which are found unmarked either in the cash book or in the passbook. The unmarked entries in the cash book or passbook indicate the reason for disagreement. Mark items in the cash book represent either the checks that are deposited in the bank but not collected and credited in the passbook, or the checks issued but not yet presented for payment. The unmarked items in the passbook are related to the credits given for interest allowed by bank, deposits for dividends, interest on investments received by bank, debits with respect to bank charges, and payments made by bank. Adjust the balance that is taken as a starting point. If the balance as per the cash book has been taken as a starting point, then the cash book balance must be adjusted in accordance with the entries passed in the passbook and vice versa. Summary. During the verification of the cash book, a difference may arise between the balances of these two books in some cases. An organization maintains records of their bank and cash transactions in the cash book. The cash book shows the balance of the bank account as well as the cash account at the end of the accounting period. A bank reconciliation statement is defined as a statement prepared at periodical intervals indicating the items that cause disagreement between the balances as per the bank columns of the cash book and the bank statement on any given date. Organizations prefer to have bank accounts through which they can deposit the money in these accounts and the banker would credit that amount in the other party's account which is involved in the transaction. Banks normally do not allow any interest on current accounts. However, if it is allowed, the concern's account is credited by bank which would enhance the organization's balance with bank. When checks are deposited in the bank for collection, the organization debits the bank account in the cash book.